So my name is Ryan Chidley. I'm a trader at APG Asset Management in Amsterdam. We are a pension fund, and I've been a buy-side equity trader in the European market since 2003 full-time, but I first began trading the European equity markets in 1997. In 2008 and 2009, the crisis had several implications, but one of the implications was the assumed rate of return on equities declined substantially. And that continues to be the environment that we're in today. So there was a lot of investment made by asset managers in transaction cost analysis, which is to measure the cost of trading. And that's been the role that's been assigned to me in addition to trading, is measuring our cost of trading in equities, in futures, in foreign exchange, etc., fixed income as well. And as Remco said, the cost of trading can basically be disaggregated into three components. One is the explicit costs, which include commissions and taxes. And the second component is what I call slippage, and I think you refer to as execution cost. Yeah. So the slippage is the primary cost of trading, and that's the number that I try to minimize, or my analysis tries to focus on and minimize at APG. And it's the chart which Remco showed from 2003 until 2011 as provided by ITG, which is a reasonably unbiased estimate of what most of the industry is experiencing. And what you will see is that the cost of trading does increase as volatility increases, but none of us in the industry have any control over volatility. That's primarily a function of what's going on in the macroeconomic environment. So what I want to talk about is what is slippage. Slippage for us means that basically someone has detected your order before you can complete it. The examples I give start back in the 1990s. When I began my career, we would pound the table furiously with our phones when trying to execute orders in the Italian bond futures pit in London. I used to work on the floor in Chicago in 97 and 98. So, I've seen this a million times, which is the market makers down on the floor of the futures exchanges would move the market away from you before you could execute the balance of your order. You see that every day today in the foreign exchange and fixed income markets, where the brokers, the broker-dealers, they'll publish one quote out to the marketplace, but the moment you try to hit them, the market moves away from you. And certainly by the time you finish your order, it's moved substantially away from you. In the case of the New York Stock Exchange, we always struggled with the NYSE specialist because of the same behavior that I've just outlined. And in today's market, the perception that we have is that the high-frequency trader has inherited that behavior. Now, this is subject to debate, but that is our perception at this time. So basically, when we look at the history of markets, what we always see is that you have someone who holds themselves out as providing a centralized source of liquidity, whether it be a futures exchange or a stock exchange or a broker-dealer. But what they do is they marry to that institution this behavior of market making / front running. And that's the behavior pattern that we struggle with on the buy side. It's always trying to sorry, I'm sick, I can't pronounce correctly. We always struggle to get around, yeah? And one of the things that we really liked about what happened in the last 10 years is with the development of broker crossing systems, I could strike a deal with Morgan Stanley, with Citibank, with JP Morgan, with whomever, and say, I only want to have certain counterparties like myself. I want to trade with them in an automated fashion, and I don't want any of these intermediaries to come between me and that liquidity. So no more market makers, no more specialists, no more high-frequency traders, no more of your proprietary traders, no short-term oriented hedge funds. And I could strike that deal with my brokers because if they didn't do as I said, it would have consequences for all the business that I do with them. Yeah? The foreign exchange trading, the fixed income trading, the other equity trading. I cannot strike that kind of deal with an exchange. So our concern with MiFID II is that now there's this pressure to re-centralize liquidity. And there's this aura of goodness given to the exchanges. But that's not our perspective, because actually throughout most of my career, I've been more harmed by exchanges as I have been by brokers or HFT. Yeah? So with respect to MiFID II, we were an advocate of the OTF Obviously, that's been disallowed to us. So what we would hope is that in the case of the MTF or the SI, that it be sufficiently defined to allow us to customize our counterparties. That is to say that in the MTF or SI that comes to existence post-MiFID II, we can do that which we valued most in the BCN structure, which is to be able to say to the to the MTF operator or the SI operator, we only want to interact with counterparties that are like APG. So think of the Norwegian Pension Fund, JP Morgan Asset Management, Templeton, whatever. Do not force us, please, to interact with HFT or to interact with someone who claims to be a market maker, ELP. Again, there's different opinions as to whether or not they are or not providing liquidity, but do not force us to interact with them. At least give us the optionality to customize our counterparties.
Thank you.